You are about to pay more for everything. Not slightly more. Not the kind of increase where you notice it at the grocery store and shrug. The kind of more that changes how you budget, how you drive, what you buy. Whether the economy you are living in right now looks anything like the economy you will be living in by the end of March. Because what happened in the last 48 hours in Iran is not just a geopolitical event. It is an energy shock. And energy shocks do not stay in the news. They come home with you. They show up at the gas pump, in your heating bill, in the price of the food on your table, in the interest rate on your mortgage, in the value of your investments. We are going to break down exactly what this war means for your money. Not in theory, not as a worst-case scenario, as the realistic range of what is coming, based on where oil is right now, where it is going, and what the specific mechanics of this conflict mean for the price of everything in your life. Stay with me, because by the end of this video, you will understand something that most of the financial media is not explaining clearly enough. This is not a 2022 repeat. This is potentially worse. And the reason why comes down to one word: Hormuz. Let's start with where we are right now. Before the strikes on Saturday, Brent crude, the international benchmark for oil, was sitting at around $72 per barrel. That is already elevated. Oil had been creeping up for weeks as analysts started pricing in the probability of exactly what just happened. The market knew this was coming, it just did not know when. Within hours of the strikes being confirmed, Brent jumped 10%. That took it to approximately $80 per barrel in early trading. That is the fear premium, the immediate market reaction to the news that the United States and Israel had launched major combat operations against one of the most strategically located oil producers on the planet. But $80 is not where this ends. That is where it starts. Here is the range that analysts are projecting right now. And it matters because each number represents a different scenario for your life. Scenario 1 is the contained conflict. Strikes continue for days, maybe a week. Iran retaliates with missiles, but does not formally close the Strait of Hormuz. Tankers are disrupted, but not stopped. The conflict ends with a ceasefire and some kind of diplomatic framework. In this scenario, Rystad Energy projects oil at $85 to $95 per barrel. Barclays says $100 is a realistic ceiling. That is roughly a 25 to 40% increase from where oil was a week ago. Scenario 2 is the prolonged war. Conflict drags on for 3 to 5 weeks. Iran makes the strait increasingly dangerous without formally closing it. Shipping companies reroute around the Gulf of Oman. Insurance premiums on tankers become prohibitive. The market prices in sustained supply disruption. Goldman Sachs puts this range at $120 to $150 per barrel. Oxford Economics models $130 as the central estimate if the strait remains contested for more than 2 weeks. Scenario 3 is a full strait closure. Iran formally blocks the passage. Mines in the water, fast boats targeting tankers. The 20 million barrels per day that flow through that 33-kilometer choke point every single day, gone. Rapidan Energy, one of the most respected energy consultancies in the world, is unambiguous. A prolonged closure of the Strait of Hormuz is a guaranteed global recession. The word they use is guaranteed. Not possible, not likely, guaranteed. Because the math is simple. 20% of global oil consumption cannot be rerouted. There is no pipeline alternative at scale. There is no reserve stockpile large enough to cover weeks of disruption. You just lost a fifth of the world's oil supply overnight, and the price goes wherever fear takes it. To understand why those numbers are realistic and not alarmist, it helps to look at what happened the last time the world faced a supply shock of this kind. In 1973, Arab oil producers cut off exports to the United States and Western Europe in retaliation for American support of Israel during the Yom Kippur War. Global oil prices quadrupled in a matter of months. The result was gas rationing, lines around the block at petrol stations, a US recession, and a decade of stagflation, the toxic combination of high inflation and low growth that took the entire 1980s to unwind. In that 1973 shock, removed roughly 7% of global supply. The Strait of Hormuz, if closed, removes 20%, nearly 3 times the scale. With a global economy that has less spare production capacity, more interconnected supply chains, and central banks that have already used most of their ammunition fighting the post-COVID inflation wave, this is not a repeat of 1973. It is potentially bigger. Now, let's translate those barrel prices into something you actually feel. When oil goes to $100 per barrel, US gas prices go to approximately $3.50 per gallon. That is up from the current $2.98. Not devastating, but noticeable. Every fill-up costs you an extra $4 or $5. When oil goes to $130, gas goes to roughly $4.25 to $4.50 per gallon. That is a 50% increase from where you were last week. If you drive 15,000 miles a year in a car that gets 30 miles per gallon, that is an extra $750 per year coming directly out of your pocket, just for gas. But gas is only the most visible number. Oil does not just run your car, it runs everything. Every product that gets shipped, which is every product, costs more to manufacture and move when oil is at $130. Airlines, which were already struggling with margin pressure, start cutting routes and raising fares. Heating oil and natural gas prices spike simultaneously because Qatar, which provides a huge portion of global LNG, ships it through the Strait of Hormuz. So your heating bill goes up. Your electricity bill goes up in regions that depend on gas-fired power generation. The food on your table costs more because fertilizers are petrochemical derivatives, and because getting food from farm to shelf requires diesel at every step of the supply chain. Think about what that actually means at the grocery store. Wheat, corn, and soybeans are grown using nitrogen fertilizers that are made from natural gas. When gas prices double, fertilizer prices double. When fertilizer prices double, farmers plant less or pass the cost on. The food gets to the warehouse on a diesel truck. It gets to the store on another diesel truck. The store runs refrigeration units that run on electricity generated partly by gas. Every step adds cost. By the time a $130 oil price works its way through that chain and shows up in your grocery bill, you are not looking at a 5 or 10% increase. You are looking at structural food price inflation that hits lower income households the hardest because they spend a larger proportion of their income on food and energy than anyone else. Capital Economics ran the numbers. Oil sustained at $100 per barrel adds 0.6 to 0.7 percentage points to global inflation. That does not sound like much until you remember that central banks have spent 3 years fighting to bring inflation down to 2%. One oil shock from a 33-kilometer stretch of water in the Persian Gulf unwinds 3 years of monetary tightening in a matter of weeks. Oxford Economics goes further. A Hormuz closure that lifts Brent to $130 pushes US inflation to 4.5%. Eurozone inflation back close to 4%. And that forces central banks to stop cutting interest rates, or worse, start raising them again, at exactly the moment when the global economy was counting on cheaper money to sustain growth. For Europe, the timing is brutal. The Eurozone had just reached its 2% inflation target for the first time since 2021. The ECB had held rates at 2% for 4 consecutive meetings. Germany had just unveiled a €500 billion fiscal expansion package that was supposed to pull the continent out of its growth slump. All of that is now under threat. An energy shock from the Gulf tears through European growth projections the way it always has. Fast, deep, and with very few policy tools left to respond. For Asia, the exposure is even more direct. China imports 40 to 45% of its oil through the Strait of Hormuz. Half its crude supply runs through that one channel. India sources nearly half its crude from the same route. Japan and South Korea combined take almost 70% of their Gulf oil shipments through the Strait. These are not marginal economies. These are the manufacturing engines of the world. When their energy costs spike, the cost of every product they make spikes with it. And those products end up on shelves in your country. McNally from Rapidan Energy described what a Hormuz closure produces in consumer behavior. Hoarding. Asian countries that suddenly realize their oil supply has been cut start a bidding war for whatever is left on the global market. Every barrel becomes worth more because every country is trying to secure the same limited supply. He called it the mother of all bidding wars. And in a bidding war, the price goes up until someone stops bidding, which means until the economy slows down enough that people stop buying things. That is what economists call demand destruction. And demand destruction is the technical term for recession. Now here's the political dimension that matters for how this resolves. Trump launched this war at a moment when US gas prices were sitting just under $3 per gallon. That number matters to him politically. He spent his entire first term and his 2024 campaign promising American voters cheap energy. He took credit for low gas prices. He blamed Democrats for high ones. And now he is the president presiding over a war that could send gas to $4.50 per gallon or higher. That creates a structural political incentive to end this conflict as quickly as possible. Not because Trump has ethical objections to the war, but because every dollar that Brent crude climbs is a dollar of political cost. His approval rating is directly connected to what Americans pay at the pump. He knows this. His advisors know this. And it means that the economic pressure from oil markets may actually be one of the strongest forces pushing toward a ceasefire. The Trump administration does have one immediate tool, the Strategic Petroleum Reserve. The SPR holds roughly 350 million barrels of oil, about 17 days of U.S. consumption at current rates. Biden drew it down during the 2022 energy crisis to lower gas prices before the midterms. Trump could do the same. An SPR release of 50 to 100 million barrels would provide a short-term cushion, a few weeks of breathing room while markets assess whether the conflict is contained or escalating. But it is not a solution to a prolonged Hormuz disruption. It is a band-aid on a supply problem that is structural, not temporary. The other tool that gets less attention is OPEC. Saudi Arabia and the UAE have spare production capacity, oil they could pump but currently are not. In theory, they could ramp up production to offset disrupted Iranian and Gulf supplies. But here's the catch. Saudi Arabia and the UAE need the Strait of Hormuz to export that oil. They have pipeline alternatives, but those pipelines carry nowhere near the volume needed to replace what flows through Hormuz. So even OPEC's spare capacity is partly hostage to the same choke point that Iran is threatening. So where does this leave you, right now, this week? If you have investments, Monday is going to be volatile. Equities are going to sell off, probably 1% to 2% at the open, according to Natixis. Potentially more if the Strait situation deteriorates over the weekend. Gold, the dollar, the yen, and U.S. Treasuries will all strengthen as investors rush to safety. Oil stocks will surge. Airline stocks will fall. Consumer discretionary, everything from retail to restaurants to travel, will come under pressure. Let's be more specific because the sector breakdown matters. Energy companies, ExxonMobil, Chevron, Shell, BP, Total Energies, will likely see their stock prices jump. They sell oil. When oil is expensive, their revenue goes up. Defense contractors will also benefit. Wars require equipment, and this war has just started. On the other side, any company that depends heavily on transport or logistics, Amazon, FedEx, UPS, faces higher operating costs immediately. Automakers face a double hit. Their supply chains get more expensive, and demand for large vehicles softens as consumers start worrying about fuel costs. And any company doing business in the Gulf region, hotel chains, construction firms, logistics operators, is looking at disrupted operations and revenue uncertainty for as long as the conflict continues. For ordinary investors with a diversified portfolio, the honest advice is do not panic sell. Markets overreact to geopolitical events in the short term and often recover quickly once the situation clarifies. The June 2025 12-day war saw equities sell off sharply at the open and then recover within days once it became clear the Strait was not disrupted. But that was a 12-day contained conflict. If this one runs longer, and the scale of what has already happened suggests it will, the recovery timeline extends with it. If you have a mortgage or a loan tied to interest rates, watch central bank guidance carefully in the coming weeks. If inflation starts moving back up because of oil, rate cuts get delayed or canceled. The mortgage rate relief that many homeowners and buyers were counting on in 2026 may not materialize. If you drive, fill up today. Not because there is going to be a gas shortage, but because the price is going up, and filling up now costs less than filling up in 2 weeks. And if you are thinking about big purchases that depend on energy prices, a new car, heating system upgrades, travel plans, wait for clarity. The next 2 to 3 weeks are going to tell us which scenario we are actually in. Contained conflict or prolonged war. And those two scenarios produce very different economic realities. Here is the bottom line. Oil markets just priced in a war premium the size of the 1973 Arab oil embargo in 48 hours. The difference between then and now is that in 1973, the world had alternatives. Today, there is no alternative to the Strait of Hormuz that works at scale. The Saudi pipeline gets you maybe 5 million barrels per day. The UAE pipeline gets you another million. The Strait moves 20 million. You cannot reroute that. You cannot stockpile your way out of that. You can only end the conflict fast enough that the disruption stays temporary. Whether that happens depends on negotiations happening right now, in the next 72 hours, through back channels you will never hear about until after they succeed or fail. The war started Saturday. The economic consequences started Monday. And every day this continues is another day that your wallet absorbs the cost of a 33-kilometer stretch of water in the Persian Gulf that one country controls and another country is willing to threaten. Drop your thoughts in the comments. What is your biggest concern? Gas prices, inflation, your investments, or something else entirely? And do you think this ends fast enough to avoid the recession scenario? Subscribe and turn on notifications. We will be back the moment oil markets open with live coverage of what the numbers actually look like. Because whatever happens Monday morning, you will want to know before the rest of the world catches up.